Hi everyone, welcome back to the Market Chat. My name is Richard Moglen. Joining me here today is Mark Ritchie II, who is a portfolio manager over at RTM Capital and is one of the traders featured in Momentum Masters alongside Mark Minervini, David Ryan, and Dan Zanger. So Mark, thank you so much for taking the time and speaking with me here today, and welcome.
Thanks for having me back, Richard.
Yeah, always a pleasure. And we're going to cover a lot today, including the current market conditions, which are definitely a little bit interesting here, especially today. We're recording this on Monday night. Google and Microsoft just reported, and we're seeing new lows in the market. So that will definitely be interesting. And we're also going to dive deep into your trading style and also focus a little bit on Powerplay. So it should be great. But to kick things off, I always like to hear about people's backgrounds a little bit so people can kind of get a sense of your experience and kind of where you come from.
Sure. So, I shared some of this before, and people may have heard some of this. Obviously, come from a trading family. My father was featured in, one of the older market wizards back in the day. He was actually more of a floor trader. Did off the floor trading as well, but that was more specifically commodities, sort of Chicago-based, Chicago Board of Trade floor operations kind of stuff. But yeah, mine is more of a journey of intellectual curiosity. And, the more I've thought about it, how does anybody get everybody's story into this business is a little bit differently. Mine certainly doesn't take a traditional Wall Street sort of arc. Mine is a little bit more of, if there's a commonality in kind of the old pit traders, of the bygone generation, it would be that similar sort of school of hard knocks. So if you read any of those old interviews or old trading books or knew anybody, usually those guys, would go to the floors, start running orders for either another firm or other locals, and then eventually get staked or start trying to find a way to break in and trade by themselves. So either their firm would put up a seat or they would have to lease, because in those days, of course, you couldn't just show up and trade. So, but it was definitely a school of hard knocks, and a lot of guys blew up a few times before they figured things out. And so the stories were similar, even though the mechanisms have kind of changed. Well, mine's a little bit similar, but I just never went to the floors, just kind of got my start on the screen. Was able to avoid at least some personal blow-ups myself, but certainly, had plenty of fits and starts along the way, trying to figure out what really worked, what didn't. I often say, like, I went to work for somebody else who was trading off the floor. That ended really bad. I think you and I talked about that last time, Richard, so people can re-listen to that if they want to. But then just sort of becoming intellectually curious in terms of, like, just why do markets work the way they do, and why do things go up and down, and what really drives stuff, and then developing a process. So, that's a little bit of the Cliff Notes version. The more I've thought about it, and I can't remember if I mentioned this last time, I've always been someone who liked games, and that kind of thing. I've shared this in some other interviews. I did a masterclass with Real Vision that where I covered some of this, but just the idea for me of certain strategy games where there's strategy, but there's also a risk element, and sort of the marrying of those two things together, where some people just really thrive in an environment where if I have superior strategy, I always win. Well, markets don't work that way. I mean, there are, in my view, certainly superior strategies, but there are a lot of elements of chance and change that go into your strategy, or that can impact your strategy. So, and you hear guys use comparisons to, poker or blackjack, I'm not an expert in either of those games, but any game where there are some elements of randomness that also impact your strategy, or sometimes even force you to deviate from what would otherwise be a good strategy, is something I've always kind of enjoyed, maybe even unconsciously. Grew up in a family where we played a lot of games, that kind of thing. I still do that with my kids today, and the classic thing you often hear from someone, they make a good play in a game, but it doesn't work out, and they think it was a bad play. And this is the same in sports, all these types of things. Well, just because it didn't work out doesn't mean it was the wrong decision, but then your emotions quickly, cause you to sometimes deviate from what was, it was a good strategy or good play. So that, really those kinds of things have always been interesting to me, and something, it's never bothered me to be in that. Well, I shouldn't say it's never bothered me. It has bothered me, but it's never thrown me for a major loop. Say, when you play a good hand in any card game and it doesn't work out, it doesn't mean it was the wrong move to play that hand. So I've always just kind of looked at speculation the same way. And then my process was, how do you figure out what a good hand is? Right. How do you actually figure out what is a higher probability play? And I think a lot of people, that's really where they struggle. They think maybe what they're doing is a higher probability situation when in effect, maybe they don't really have an edge at all.
Right. And going back into your earlier years and when you're still trying to figure everything out, what were some mistakes that you were making over and over that looking back on, now you're seeing people on Twitter, newer traders, you see them kind of making the same thing. What kind of advice in terms of early mistakes, beginner mistakes, do you see people making over and over again?
It's a really good question. And this is something, because I do trader education and some coaching along with Mark Minervini at Minervini Private Access, for those who aren't aware. And this is something, I've often wondered in terms of like, what is it about why some people seem to be able to figure it out and others don't, or why the learning curve is steeper for some. And there can be a lot of reasons. And, one of the things Mark sort of taught me early on, not directly, but indirectly, both directly and indirectly, is that, trading and speculation really is it's a reflection of your personality.
Right.
Which is, so you kind of have to figure out, there's nothing like trading to help you figure out like, what are some of my tendencies and weaknesses? So it as an overgeneralization would be, you need to figure out what your weaknesses are and try and address those, but they're different for everybody. So obviously the classic one of cutting losses, of course, if you don't do that, you're dead on arrival in this business, right? Well, with that though comes so many other things. Style drift is another big one, that everybody hears about. You have a sort of a process or a strategy, you're committed to it, but it's just not, maybe it's not in a good period for that right now. Even for me personally, that's where, my bread and butter sort of is. It's been difficult, but I'm not running to another strategy where most people immediately go, well, this doesn't work. Let's try trend following. Well, trend following not work. Let's try mean reversion. Well, that doesn't. Let's try stat arb, or let's try value. And then they wind up, cycling through all the strategies when they're not working, and they're never there when anything is working. So that would be another one. I think the biggest thing though for guys and gals that are new is, in a very general sense, the ability to grind it out. If you want to call that drive, if you want to call it grit, because there's going to be periods where you're just going to sit there and wonder, well, one, is this worth it? Is this working? Those type of voices you hear in your head when things aren't going well. And it seems that across all strategies, people that tend to really get over the hump and find their way, I think, in trading and speculation, have been able to weather those type of sort of internal battles, or have been able to bounce back from tough periods. If you're somebody who, doesn't do well under any form of adversity, you're going to have to learn how, or you're going to struggle. So, and then the other, I think with that is obviously discipline, but there are plenty of people who are disciplined in terms of they can follow rules, but when following the rules, leads to even still a period that's difficult or tough, or, where they're not making a whole lot of progress. If you're the type of person to throw up your hands and give up, you're going to have a difficult time as well. So those are general, but I think they almost have to go, that's the horse going before the cart. You have to have an understanding of those things, and a real commitment to this, before you're probably going to see at least the level of success that I think most people are probably aspiring to when they start out.
Absolutely. And I like how you brought up about, a successful strategy is not going to work every single day, every single week, every single month. Right now, we're in a corrective phase, style similar to ours, where we're trading those high quality, super strong market leaders. That type of thing aren't necessarily in vogue right now. It will come around again. We just have to be ready. And I wonder, on the discipline side of things, what do you do to make sure that you do your homework, do your weekend routine, daily routine, even when your system isn't quite working, to make sure that you're ready once those conditions do come back again?
I would make another point too, that I think most people don't understand, is that you don't want things to work all the time. I know that it sounds counterintuitive, but if it worked all of the time, then eventually it will work none of the time. And most people really don't understand this. Mm-hmm. And I have to say, probably for the first, half a dozen years or so I was doing this, I didn't fully understand it, because the novice just thinks, well, I should just make money on every trade and every day, and it's just that simple. And if you study the history of markets, any edges that are that obvious, and there are edges that sometimes exist where it just feels like, wow, you just make money all the time, but they go away, because then all the other participants, markets aren't perfectly efficient, but they're generally efficient enough to take those away. If you read, again, the last 100 years of different market participants, when edges are that obvious or that big, the market eventually takes them away. So there is this tension in terms of, this isn't working. Does that mean it doesn't work anymore at all? Well, let's just take the idea of, say, trying to trade or invest in disruptive type of just growth, or growth in general. You're telling me there's never going to be a period where companies with superior growth forecasts aren't going to outperform, or that these type of stocks aren't going to go public, have consolidations, and where lots more people are going to want to buy them than sell them? That is, as long as there's speculation in free markets, I think that's going to be around. Will you be there to take advantage of it and survive the periods where, these stocks aren't working? That's the $64 million question. So to then get on to your question, well, what do you do to make sure you stay sharp and those type of things? Well, the only way I know how to stay in sync with the market is to be running through your process. Mm-hmm. And this is where I really think, more so now than maybe ever, I've been doing this now full time since 2007, and on my own since late 2009. So, 13 to 15 years full time, depending on how you look at it. But I've had the same process now for over a decade. And I would challenge anybody, if you will discipline yourself to creating, even if you just make the process up, I'm not saying just, grab things out of thin air, but if you will create your own process, avoid all the garbage you see on FinTwit and TV or anywhere else, lock yourself in your trading office, and just run through the same thing, you will have a different view of the world and of the market than anybody else, right, wrong, or indifferent. In my view, that is extremely valuable, because eventually what I think happens is you start to see patterns, you pick up on tendencies. And Marty Schwartz talked about this in, I think, his old book. It was like the chart started talking to him. Well, what he really meant is, like, he just sort of developed that sixth sense of, I've seen this before, I've seen these few things line up, and then all of a sudden, well, that's precisely how I keep a pulse on things. People ask, how did you know when to raise cash or whatever? It's like, I've been running through this process again and again and again. And when I start to see conditions like we see right now, or for the last 2 to 3 months, it's as easy as anything else. It's sort of like, how did you figure out how to put one foot in front of the other when you're walking down the street? You don't have to think about it anymore. It is second nature, like I could close your eyes, Richard, as long as the ground is flat, you'll keep your balance, right?
Yeah.
You're going to be able to stay on your 2 feet. I feel the same way in periods where the market is really unhealthy. People are shocked. Well, how'd you end up in so much cash? Well, because the stocks, the process, everything was telling me that well ahead of time. Right. But I could tell anybody else, this is what I do it tomorrow. It's not going to help them. You have to do this consistently. So it's that same idea of just having your process needs to become a primary function of really who you are as a speculator. So they're not removed. It's not like, well, there's Mark Ritchie's opinions and then there's this process. These two they're closer than this. I mean, it's like they're sewed together, if that makes sense. So there's no option to not run through it. That's the foundation.
Absolutely. And of course, nobody's process is going to be the same, but in general, do you have kind of systematic steps that you do to keep an eye on the general market, look for setups, and just judge the overall health of the market? What in general do you kind of do to stay in the loop and keep an eye on things?
Yeah, just screening equities. Actually, normally, I don't even look at the general market. I'll look at it at the end of the day, or like right now, I'm hardly in anything. So, I was watching, the S&P and NASDAQ, just, taking out support levels today, that type of thing. But yeah, I do not gauge my view on the market from, say, the chart of the S&P or the NASDAQ. I'm just, running through the relative strength, high relative strength list. I run through sort of a high composite list, and there's 3-4 screens, none of which are secret or proprietary. It's essentially screening 500 to 800 stocks. Is upward of 1,000 a day, and then building a smaller watch list. So a good example would be, normally I have a watch list between 50 and 100 names that I call like it's sort of like a secondary watch list, and then a primary watch list I'll create off of that. Well, right now I have the smallest secondary watch list I've had in a long time, just because nothing's really looking that good. Nothing's really close to buyable. Where the bigger that is and the more attractive it looks, generally the more healthy I think the market is. The smaller it is, it's almost like I don't even need a chart of the index. In fact, based on my work, I'm surprised the index aren't lower. If you were just to give me my primary indicators, I would be guessing the NASDAQ and S&P are probably lower than they already are. Doesn't mean they're going to go there, but it wouldn't surprise me if they do.
Yeah, absolutely. And focusing a little bit on your daily routine and maybe taking it back to a time which is a little bit more normal, where we're in an uptrend, things are doing well. How many stocks are you focused on day to day, looking to potentially add or buy starter positions in? How many are you focused on a particular day?
Well, as many as I think are potentially buyable, I want to monitor. And so this is one of the things, that I do with MPA as well, is just kind of, helping to say, like, what is, how big is the universe right now of potentially buyable ideas? If there's one idea, that's a health indicator. It's not as healthy. If there's 5, great. If there's 30, that's phenomenal. The more, the better. So yeah, in a healthier period, I want to see usually groups of stocks that are either acting well and somewhat in concert. So, Mark Minervini often describes this as waves, where you see like a first wave of stocks that look like they're leading, they set up and they start to work. And then you often see another wave that's sometimes either coincident with a market pullback or consolidation. And you're just kind of letting the stocks guide you. What are the strong groups? What are the strong names within those groups? And really, it's sort of the idea of like breakouts and names really moving in earnest. I use the cockroach analogy sometimes. Like if you see one in your apartment, it's probably more, or mice, or however you want to think about it. You know what I mean? If one is working, the odds of more working are much higher, not less. And these, the distributions of wins and losses tend to come in bunches, which is also why, I like to see I don't want to see just one name. If I have to pick the only name in the tradable universe that's working, I can tell you it's going to be tough sledding. Where I would much rather be able to kind of, pick 3-4 names out of 15 or 20 and see them all kind of holding up on balance.
Yeah, very cool. And could you kind of walk me through your daily routine where basically all the steps from where you wake up to the opening bell? How are you managing your list? How are you setting alerts? What are you watching when that bell rings? And also the time frames you're kind of looking at, whether you focus just on the daily or you've got a weekly on there, 65-minute and hourly. What is your kind of overall process day to day?
Sure. So, and I didn't answer the question before. Generally, I will set alarms on anything that I think is potentially interesting or viable. And I do that, again, just sort of to gauge market health. Doesn't mean I'm going to buy it, but it often just sort of signals me in terms of if I'm setting, say, 3 alarms and they're all going off, that tells me, okay, there's at least a bid, for, more or less growth momentum, because that tends to be where I try and be agnostic, but I favor those areas just because that's where I've, found the best sort of success historically in terms of, my own trading. But so the normal routine is I tend to start about an hour and a half before the open. Then I go through my secondary and primary lists, set any alarms for anything that I think is interesting. I cross-check all my lists with my co-portfolio manager because we run through the same process, and then we sort of compare notes. But we usually do it we always do it independently, and sort of it's like making sure you don't miss anything. And then similarly, I'll compare notes with the MPA platform as well. Everything there that's on buy alert, because we're trading generally the same universe. I will then look at obviously any open positions. I'll check the market, of course, pre-market. If we're called much higher or lower, of course, I want to know about that, or any individual stocks. Like, let's say you're in a stock and it had earnings or something like that, then I'm obviously going to be aware of that. But all things being equal, it's sort of going over your playbook beforehand. So it's looking at my primary, secondary watch list, setting any alarms. And then if there's names I'm potentially interested in, I'll run any potential position sizes for what we're going to be buying, and then have those orders either staged and ready to go, or at least knowing how many shares I want to buy in terms of, I've just got an old school notepad like anybody else sitting in front of me. And then, the normal trading day is usually kind of boring. I mean, I know people like to think that it's exciting, but generally it's not that exciting. And it's just monitoring. If you have open positions, obviously those are on my primary screen. And then throughout the day, sometimes depending on how busy things are or not, I will normally go through my primary and secondary watch list even during the day, just to see how things. I might look at it at an aerial view where you can just kind of, last couple of days, everything's dead red, and I'm just going through and kicking stuff off, and vice versa. Then let's say I've got something on my secondary watch list that looks, even better to me intraday. I might set an alarm. It's the same process. And then towards the end of the day, if it's a quieter day, I might start screening in the last, portion of the day to get a little bit of a head start. But then it's that same process I discussed earlier. You go through all your screens, add anything to watch lists or subtract based upon how it acted that day. And then as far as my screen setup goes, it's nothing really fancy. I look at multiple time frames. When I screen, I look at daily and weekly on everything. And then I use, my primary charting package. I just use TradeStation's standard TWS platform. So I just have multiple charts whenever you click a symbol. I've got an intraday. I don't trade off it, but I have it there along with the daily and weekly as well. And that's pretty much it. So I try and keep it simple. I've been using kind of the same setup, again, for more than a decade in terms of charting and all that stuff. So I don't use indicators on charts or anything like that. Got a few moving averages, but nothing fancy or proprietary or anything like that.
Yep. And I know somebody watching this right now has this question. So, because I always get it in the comments. So, when a stock that you're interested in buying on that day, your alert comes off, you see it moving, are you acting on it if it happens right at 9:31, or do you like to wait throughout the day to see, is there really volume coming in? Does it seem like there's an institutional bid behind it as it's moving, or right as it enters that pivot point, goes through that's when you buy?
Generally, it's if it starts moving through a pivot point and I know that I want to buy it, I will buy it, or at least I'll start the position. So, and I have modified this a little as I've grown in terms of the size of the account, because there are occasionally, some aberrant action in the first 30 minutes or that kind of thing. So let's say, there's a stock that I want to buy through 50 and it pokes its head, out in the first minute at, 50 and a nickel, 50.05. I might give it a few minutes, or I might want to see at least some more than 100 shares trade through that level or that kind of thing before I'm going to start, jumping in there. But I will usually buy something. Or let's say it's still tight enough. What I may do is in that example, I might reset the alarm. So it just takes out the pivot by a nickel or a dime. I might set it 20 or 30 cents higher. But it is, if I'm not buying right then, I am sort of putting in a secondary condition that is going to force me to buy in the ensuing 5 to 10 to 30 minutes, if that makes sense.
Yeah, that does. And I meant to actually ask this earlier, but could you tell us a little bit about kind of your time frame, how you would kind of define your own style, and also if you've got those statistics handy, kind of your batting average, average gain, average loss, because I think that's really helpful for people watching to get a sense of kind of how you trade as a whole, especially on the loss cutting side. I think that's really interesting.
Sure. So I generally, and I've kind of evolved. It's the same process, but in terms of, so very early on, first couple of years, I was more of a just short-term trader. And for me, that would mean days to weeks at most. And if I had quick profits, I generally took them. There was a couple of reasons for this. One, I'm a big believer in small gains compounded over time. And the best way to rack up small gains is just turn your edge over. So if you have an edge, the more times you can turn it over, and the smaller your account is, the easier that is to do. This is why, smaller accounts can do 500% in a given year, because they don't have any liquidity restrictions, and they can turn that edge over really quickly. So that was, primarily part of the reason. But then also studying my own results, I realized, wow, I was selling sometimes too early in certain conditions. So, and morphed over time into selling portions to finance bigger gains. Meaning, so now I will always generally have a trading scale where I'm scaling out of a piece to finance a hold. And I think you and I talked about this last time, but an ideal trade would be something where I can scale out of a piece at, multiples of my risk, say, anywhere from 2 to 5 to 1, and then hold a portion for 5 to 15, 5 to 15 to 1. Right. I'm always thinking in terms of probabilities as well, or risk units in my head. But, that's then the other portion of that, though, is, where we are in the context. So right now, Richard, everything's pretty much a trade, because this environment is extremely tricky. So I am looking to, if I can print some black ink, I'm taking it. Conversely though, should I see that maybe we put in what feels like a cyclical or secular bottom, I'm going to be looking to play a majority of the positions for bigger moves, especially if I think I'm positioned in a key leader or two. So it's a combination of knowing where we are in the cycle as well, which comes with time. There's nothing wrong, though, in my view, especially if you're smaller. Well, even if you're bigger, some of this is style of just, turn it and burn it. There's nothing wrong with just turning the edge over. And as I said, provided you don't have liquidity constraints, that is really the purest way, I think, to grow an account and to keep your equity curve smooth. Most people don't realize that the bigger move you try and play, the more volatile your equity curve is potentially going to be. So that's even where I try and sell portions of positions or trade around positions, not because I want to, but because that's the best way, to smoothen out your equity curve. You've got to lighten up into strength and then look for subsequent maybe pivots to buy back in weakness.
Perfect. Yeah. And just to kind of maybe help you elaborate on that a little bit, in terms of that situational awareness about what kind of environment we're in, coming out of an extensive correction like we're currently going into and are in, as well as, for instance, that 2020 correction as well. That's a type of environment where if we do get that nice push up, it looks like we're starting a new uptrend. That's when you're going to try to hold things for that longer move. But later on in that cycle where we've had an extensive run and we're just going through an intermediate correction and coming out of that, that's when it's a more of a short-term trading environment. Is that right? Would you say that's correct?
Yeah, I think that's a pretty fair generalization. I mean, listen, the market, the overall market, it normally should just be ignored. However, when it's in a period of stress, you mentioned 2020, 2018, you can look at the period right now. When we come out of those periods, think of it like there's a giant weight sitting on the market, and there's been a lot of, in bear markets, people are forced to sell things they don't want to sell. Right. When there's forced sellers, that means often there's forced buyers on the other side, or things that are trading at levels that won't stay there. So the strongest potential leaders, we don't know what they are right now, right. Are going to be that much more explosive on the other side, which is why early on, the best leaders, they don't give you much pullback. They don't give you opportunities. If you get 4 opportunities to buy a stock, it's probably not a leader. It's just like, that's not how it works. The strongest names make it really hard. And if you get sold out of them, it's very tough to often get them back. That's why, also it doesn't often require these gigantic positions early in a new cycle, because the moves can be that much bigger. So yes, that's kind of how I think about it.
And is there a time or environment where you favor breakout style trades versus more pullback style trades? I was curious about that.
That has really tended to be, each cycle's been a little bit different. So there have been times where some work better than others, where, maybe, to me, they're all forms of breakouts, because if I'm buying a pullback, I'm not just buying into a falling market. I'm usually waiting for the market to pull back and then put in some type of consolidation. I at least want to see it turn back up in my favor. So, it would just depend, where sometimes, and some of this depends on the nature of the general market too, where sometimes if the general market just, puts in, like in 2020, where we had this really big V-shaped move, well, a lot of the stocks then sort of had these big breaks and then these mid to high handles. Well, that was because as the market paused out, the stock ripped back and then, put in the handles. Where in other periods, like I remember in 2010, they were a lot more sort of like smooth cup and handles, where they were a little more jagged in 2020. Or in other periods, you see, the technical theme is a little bit different. Well, again, if you're just running through the process, you'll just start to see what looks like a theme. Wow, there's a ton of handles. Wow, there's a ton of, cheat areas or that kind of thing. So, I don't have one that I favor. It's more of, again, what does it look like that is setting up in earnest? And then more importantly, if they're working,
Right.
The theme of the last 9 months has been, if it looks really good, it's probably failure prone.
Yeah.
Because everybody's eyes are on it. There's only, and there has not been that institutional bid that is continuing to keep stocks making higher lows. That's the key. You know, the breakouts may work for a day, but they don't have the staying power, and that's because there just hasn't been that institutional appetite for, you know, breakouts into new highs, or to be bidding up stocks that are in new high ground.
Fantastic. Yeah, absolutely. And I wanted to get a little bit deeper into some specific setups that you like to use. And you prepared a few examples of a power play type setup, which I know you like to use. So feel free to share your screen and let's go ahead and walk through how you analyze the charts as well as execute that setup.
Sure. So, you know, you would ask if I can share some power plays, and, you know, that's something this is sort of, in my mind, it's a powerful setup. Obviously, it's more niche in that sometimes there aren't any, you know,
Yep.
or you go through periods of time where they're just, it's not very common. It's often very misdiagnosed, in my view. But, you know, that you can read about this in Mark Minervini's book, his first one, Think and Trade. No, sorry, that's the second book. Trade Like a Stock Market Wizard is the first one, where he just sort of outlines the rules. But the simple rule is, look, the stock has had an explosive move, and explosive, you know, as he defines it, or I would, is that, you know, it has, you know, doubled or had or more in a short period of time, and not given much of the move back. So I threw up this particular example of CUTR, which is really one of the only ideas, you know, on that watch list for me that might set up here. It's not ready yet, but you can just kind of tell the stock has had this explosive move. So here's your double. The problem is, for most people, they go, oh, this must be a you know, a power play. And the other part of it is it hasn't corrected much. So if you look, you know, this stock has gone from 74 down to 61. This is right on sort of the edge of about, you know, just over 20-ish%. Any more, and I would say it's already given back too much. And then you look down here, volume has been, you know, certainly lower, and you're getting some support. If this were to set up, you know, and tighten up, especially as the market goes lower, that's a stock I'm getting really interested in. And if you just think about it in terms of, this stock has had a huge run and has had very little profit taking. So that's telling you that there's something going on here. If I'm not mistaken, I looked into this. These guys had some type of device approval. You know, it's the biotech situation. If I'm not mistaken. And that's something you often want to check as well. Sometimes there is no news. That doesn't mean you shouldn't keep it on your radar. You absolutely should, because the market is telling you there is something going on. Just because it hasn't hit the tape yet doesn't mean it's not, you know, that there aren't some smart players that know more than we do. But this sort of reminded me, like, if this stock were to tighten up here, especially given the conditions of the market, which are very poor, for anybody who, you know, hasn't been paying attention, that it would make the setup even more potentially interesting or powerful, because you have a market that is holding this back. And if this were to turn up and sort of break out, it's just that much stronger. The example, you know, I was going to show of one similar, this is a stock I traded back in 2018. Excuse me while I back up this chart.
Yeah, no worries.
But so right here, and actually this is an interesting example for two reasons. Sometimes these power plays, or these type of setups, they have multiple iterations if it's really strong. So you can see this was a stock that went from 8 to 20. I wouldn't call this a great tightening over here, but it was certainly potentially playable. Then doubled again. It really came on my radar in here. So here you have a stock went from 20 to 40. The irony is, this shakeout right here was this is February 1st. You know, if I had one of my other screens, I could show both charts. But if you look at a chart of the S&P on this day, was sort of that Volmageddon VIX collapse in early 2018. The market got absolutely pummeled here, and this stock shook out and closed right here, then went tight a couple days.
That's so tight right there. That's
super
crazy.
tight. Now this was a little bit of a thinner issue. Didn't trade a ton of shares, but obviously this is in its own universe. It is marching to the beat of its own drummer. And the other irony is, as soon as this thing broke out, you know, above 48, I think I was trying to buy 10 or 20,000 shares. I can't remember. And I got a bad fill and it never looked back. I mean, it just, this was just straight up, 8 of 9 days or something like that. And if you look, then it just, this was a double in a couple of weeks. And that's that's almost like an added power. The setup is great and you have this momentum and no profit taking. Then you, again, to my point about the general market was also sitting on top of it. Once that pressure comes off, it's the classic beach ball underwater. It has nowhere to go but higher. I made that point with oil earlier in the year. I think back in January, this is another sort of technique I use to analyze stocks all the time. If the market is weak and you've got stocks that won't break, it doesn't necessarily mean it has to be as weak as it is right now. But earlier in the year, you had the market, trading relatively poorly in January, and oil was just, 1% or 2% below highs. All the oil stocks, everything just holding up really well. It was just screaming at you that it wanted to potentially go higher. Similar situation. Will this CUTR work out the same way? Maybe, maybe not. And I will add, Richard, I think it's really important for, I don't know, every 50 or 100 potential power play type moves, I probably trade one.
Yeah.
So there's a lot of stocks that do not make the cut. Selectivity is important. And, I can give a couple examples of some ones this year. I don't particularly like it when people only show their winners. So I'll give a couple of examples. This was one I was just knocked out of the other day. U.S. Steel. If you look, this really wasn't the best setup either. But here's a double. You got a really strong move here. Stock tried to consolidate. I bought it on this day right here, as it was kind of coming through this little pivot. Not the best setup, but you could see this little consolidation. Volume came down, dried up, very little profit taking. I bought it with a tight stop, stopped out on this red candle right here. Obviously didn't work. This is, again, with these situations, I have to stress, if you're going to even attempt to trade these kind of setups, you have to trade with tighter stops, because the other side can be, when they break, they can break hard. So you have to have a quick trigger on both sides, and you have to potentially be willing, I think, to try them, maybe more than one time, because they also, I would much rather try a situation like this 2 or 3 times to get the timing right. Whereas a lot of people don't like, if that's something that's going to bother you, this type of a setup is not for you. And you did ask earlier, I forgot to mention, what's my win rate, that type of thing. With power plays, it's about 40%. That's actually pretty consistent with most of my trading. I'm wrong more than I'm right. And on average, I make about 3 times what I risk. Power plays a little bit more. It's actually more like 4 to 5 times on average. But and with power plays, I think my win rate's even a little below 40. It's probably more like high 30s, 37, 38%, something like that.
And speaking of one that didn't work, I think VYGR was a thinner name that was setting up recently that had a really disastrous failure. I think it was down 20+% in a day. So yeah, you gotta use your stops and protect your downside as well.
Yeah, this is a good example of actually one that was on my radar that I didn't play, and I can tell you why I didn't. It just wasn't tight enough.
Yeah, it was a little wicky there, right? Before it actually tried to go.
It's kind of wedging up here. You can see, this is the type of situation in a good market that will work. In a market like we've had, it won't. I can't remember too if there was news on. Yeah, this is exactly why. Now, keep in mind too, we're talking about a stock that's under $10. So you've got to discount it a little bit. And I think there was no earnings and sales here either. This is, very speculative. There have been a few like this. TH was another one, which, we can look at. These are more symptomatic in my view of just the environment we're in. You're not, in a situation like this, when bids dry up, things just get buried. And that's exactly the environment we've been in. This TH situation, this worked again for a little bit and then promptly failed. a situation like this, just for, let's say, again, this is highly speculative for me. This is the type of setup, certainly earlier in my career, I would have been all over. This wasn't quite tight enough, for me. Even it's okay, but it's not ideal. Either way, though, it breaks out. You have a really nice one-day rally and then a prompt failure. Well, again, these are the type of, normally I would have probably, I'm going to just do a quick measurement here. This is more than 20%, I think. I would have probably sold a piece of this on this day, moved my stop to break even. So a trade like this would be a net winner for me, although not maybe as big as I would otherwise want to. Looking through my lists, I don't think I've had a power play winner this year. So I just showed, I think I've had 2 or 3 trades, all of which have been losers. One of my better ones from last year was this Quad U, uranium name. And actually, I think I used this for another interview I did because I still had my annotations in here. You can see, this was a lower price stock, but it was still pretty liquid. So I played it. Plus, I knew a lot about the fundamentals. I was buying coming right out of this little consolidation. And, this was almost, close to a double in, 6 weeks or something like that. So, that's the kind of move you're potentially looking at catching. But you've got to be willing to, like I said before, you could have actually played this here and you actually could have bought it again right here. You could buy this on this green candle day with a stop right in here. I can't remember. And normally for me, if I didn't have a full line on here, I would be adding to the position here. So that's how I would kind of treat it. And if you look right in here, volume sort of dried up again in these 3 days. That's constructive action. You can see here on these 2 green candles, you had nice volume, another nice volume. That's sort of telling you there's more buyers and sellers in here. And if those buyers are going to continue, they're going to push prices higher. Sure enough, that's what happened. I can also show some crypto examples, if you like, just because that's where, at least I've seen, without any fundamentals, this pattern shows up when that market is in favor and it's risk on. It's just like, it's the same thing as equities. It's a different asset class, but the supply and demand and imbalance and the exact same setups take place in those markets, just like in equities.
Yeah, I'd love to go through those. But first, I've got a few questions about the overall setup and kind of the buy point you look for. So first of all, are there kind of some characteristics to that high tight flag that, or power play as we call it, that kind of move it to the top of your list? Like with that HLG chart, we had that big shakeout. It got real tight. Is that something that pushes it to the forefront of your list? And also, how much do you take into account kind of the driver behind the price move? If you look into the fundamentals, see there's, an announcement of a new product, whatever it is, how does that factor into the equation? And also, sorry to add another component of this question, but do you like to see kind of a long period of neglect before the high tight flag, before that, double or more off the bottom? Does that kind of add to the potential of the setup?
All good questions. So normally I want to see really high relative strength. So that's sort of almost like a prerequisite. That's where they would tend to come from, would be my high relative strength screen to begin with. As far as the driver, it's not, I'm not going to overweight one because, well, this has a new drug and this one had a good earnings or that kind of things. But normally it is those type of announcements that will produce, that kind of power, or it could be, some type of a news or a headline. I remember one of the ones early in my career, it was like 2011, people can look this up. I think it was Weight Watchers. I can't remember if they announced that Oprah was coming on as like a, celebrity spokesperson for the product. He was going to be a major endorser and sort of pusher of the product.
Right.
But, and that started this, this sort of power play setup. I don't try and get into the tea leaves too much. I'll just look to see what it is. The one I would avoid, though, is the mergers and acquisitions type of stuff.
Yeah.
So if a stock is doubled or had this big move because it's under proposed merger, that's an avoid. because all the juice is out of the trade. And in fact, now all you have is the downside risk in case the merger or acquisition falls through. You're going to be holding something. I would also add, if it's a biotech with no earnings and sales, so it is just trading on, that sort of future, approval catalyst or that type of thing, or continued good news from the drug, I'll at least check a little bit in terms of like if they're on the FDA calendar or that kind of thing, soon it's an avoid, because those are those binary events where stocks can just get absolutely crushed if the news isn't good. So that would be the other caveat. But otherwise, no, I don't put more into it. As far as the actual technicals, that's a little bit more art than science. I kind of know what I want to see. You asked about shakeouts. The more shakeouts a stock has, often the better. Just tells me it's cleaned out some of the loose, weak hands. Doesn't mean that it won't happen again. Yeah. To my point before, often you need to be willing to be shaken out once, before you get back on. But no, I don't have, the general rule, I guess, would be the tighter the better, Yeah. And because it's kind of telling, these charts, it's not that they're telling a clear story, but occasionally, my eye, I feel like, is just trained enough to know what I kind of want to see, where it sort of jumps off the page to say, wow, this is potentially, powerful. And the more you do this, the better you get at it.
Yeah. And going back to the last part of that question, do you like to see a long period of neglect where the stock's kind of gone sideways before it? And also kind of related to that, how does overhead supply factor into it? Like, because a lot of those oil stocks, which have had tremendous moves, I mean, you look back at their charts on a monthly, and yeah, it's had this super powerful move off the bottom earlier this year, but there's all that overhead supply going back, a decade. So yeah, I wanted to see how that factors into it.
Great question. Yeah, I forgot to answer that. So I would say, even in a situation like oil, like I did play Oxy recently along with everybody else, and probably got stopped out along with everybody else. And there's a classic case of why sometimes when a trade is too obvious, it's more failure prone. Also, we've had very few setups, which tells me everybody and their brother who's looking at this type of stuff was all looking at the same thing. So in the case of even something like oil, the group would matter a little more. Oil and the cyclicals, steel, same thing. It's ironic though. I traded those smaller because I discounted the fact that they're in groups that are not usually as explosive, because there's nothing going on in steel that is that incredible that is usually going to produce this massive asymmetric move. Doesn't mean you shouldn't play it or trade it. But compare that to sort of like high growth tech, biotech, even consumer retail that can have explosive earnings and sales, are often a little bit different. So, yeah, that's kind of how I think about those. I'm trying to remember exactly what the second part of the question was.
It was about the overhead supply, how you
overhead
factored
supply,
into
yes,
that.
and
yes.
the dormancy. So
Yes.
Ideally, yes. So I will say, let's say something has been trending up for a while and then has this explosive move. That's more of a sign of the end. Again, doesn't mean I wouldn't trade it, but if it's already been trending for a long period of time and then has an explosive move, that is potentially more signs of a blow off top. Now, blow off tops doesn't mean you can't trade them, but you got to be quick on the trigger with this type of setup regardless. But yeah, I would tend to discount that a little more. Ideally, yes, I'd like to see the stock, maybe it hasn't been going anywhere, and then all of a sudden it has this rapid move where that takes a lot of people by surprise. But I still would like to see, even in the most recent relative strength, I'd like to see that starting to pick up. So maybe it isn't 99, but it's 95 and the relative strength line is really starting to move up. That's then, in the universe. And sometimes you'll see where the long-term moving averages haven't even turned yet. Mark, I think, calls that an early turn situation. But that would be, the less overhead supply, the better. But the further back would be the more, interesting. Because sometimes you get these power plays where the stock is And this is a good point, actually, Richard, because I think we're going to see some of this with a lot of these former leaders. So let's say we've got stocks that have gotten buried. They're off 60, 70, 80, some cases even 90%. Well, the stock may double off the lows, but it is going to be running into an ocean of overhead supply to the left. Right. I would rather avoid those, or certainly if I'm going to trade them, I'm going to trade them for a much shorter move, because you're just, you're running into that massive, weight that is sitting over the stock. Again, doesn't mean you can't trade it, but everything in context. So if you look to the left on the chart and you see lots of trapped buyers, they're going to be sellers at some point. So I'm much more likely to pass on those type of trades altogether. And if I play them, I'm much more likely to play them for even a shorter term move.
Makes sense. And I realize we haven't talked about this specific buy point that you like to use for these. Some people like to use the high of the overall high tight flag, but it seems, looking at these examples, you like to look for, really tight price action, low volume, a clear pivot point, and buy through there. So I was wondering, well, first of all, is that right? And also, where are you kind of managing your risk there? Where are you placing that initial stop loss on a kind of general type buy?
Yeah, generally would just be through the pivot, and then it's where the pivot forms. Sometimes, again, these pivots form in different spots. The tighter it is, the tighter the pivot, the better. But yeah, often I'm, in this case, I'm buying through this 47.50 area, and I'm putting my stop through this 45.50 area. I can, one of these ones I just traded, a few weeks ago in crypto was this Terra Luna. I'll show as a more recent example. Mm-hmm. I was buying. Here you had this doubled off the lows and put in this little consolidation here. I bought right through this. I'll just draw a little line here. Mm-hmm. I bought right through this little pivot here. Stop was, in the obvious spot right here. And in this case, I stopped out. I didn't sell any into this run, where in some cases, this was sort of 3-4 to 1. I would be peeling off a piece. In this case, I didn't. However, that strong of a move kind of said, hey, we should probably move this to break even. And I trimmed it off at, sort of nothing gained, nothing lost. And this is generally how I would trade any situation like this, meaning I may not sell at multiples of my risk, but if I'm not selling, I'm going to move risk controls up. I don't want to let a big winner turn into a loser.
Yeah, perfect. And since these are such powerful moves, you talked a little bit just now about how you're moving up your stop, but what would cause you to take a partial off and try to play that remainder for a bigger move?
Sure. Well, normally, in this case is a good example. Why didn't I sell a piece? Well, I was looking at sort of the crypto market in general, saying, hey, maybe this bottom, this was the first one to kind of make new highs. If this is a key leader, it's probably going to go a lot higher. Consequently, it may still be, because it's relative to the rest of that world, it's still holding up pretty well. So I didn't want to part with a piece, but usually I will always set an alarm at, say, somewhere between 4 or 5 to 1. And then at least I'll monitor the situation. And I set a lot of alarms, not to, if it's stop alarms, those are get me out of Dodge alarms. But on the upside, they're more reference points. I just want to see, well, when we get to multiples of my risk level, where are we? How extended is the chart? How is the rest of my trading going? And then I'll make some decisions. Maybe I'll move my stop up. And generally, as I said before, when I get at several multiples of risk, that's when I'm at least thinking I'm not going to take principal risk anymore. Yeah. Exactly. I'm not going to lose on this anymore. So that's how I handle this situation.
Yeah, perfect. And thinking back in history, are there any kind of model book type high type flag, Powerplay stocks that come to mind that you think people who want to learn more about this type of setup can go back and study? Are there any that come to mind?
Well, I mean, they're really everywhere in terms of, I don't say that every chart has one. There are plenty of stocks that make big moves that I haven't participated in. And not every stock gives you a great setup, or in this case, crypto. My point would be that it's just supply and demand. There's no magic here. It doesn't work all the time, to our point earlier, but on occasion, it can present itself as a really powerful, place to get on board. And normally, this type of setup looks and feels a little scary because, well, it's had this big move, and that's where I think the proper analysis isn't just it having a big move. It has to have a number of things. One of the better ones of the last year for me was, I can show is this polka dot. This is a crypto. I really didn't know any. I mean, I know a little bit about it, but here's the setup. It's just classic. You have this actually went up from 6 to 18, and then just marked some time. I was buying it right through this little pivot here. And within the other thing I would say, the best ones tend to put you under very little pressure. So that would be a general rule. If you get yourself positioned properly and you find yourself at a gain right away in this type of a situation, you want to try and give it the benefit of the doubt. You have to also have sell rules. Let me be very clear on that. Into profits and weakness. You don't give it the benefit of the doubt if it blows through your stop a day later. Do not do that. However, if you really nail the timing, they can be powerful. So, when I scroll forward, this was a double in, 4 weeks, with very little pressure. I think I wound up even going even higher from there. But, I was a seller into this move. The other thing generally I do, you can even, these stocks have a little bit of a character. So, if you look at something like this, okay, this is moving in a pretty nice, aggressive upward sloping channel. Then it goes even high. Then it starts to almost get parabolic.
Right.
I'm lightening up in here. I might not sell all of it, or I'm lightening up and then going to start a trail, because it's sort of like if you ever gone to an air show, when the plane really starts to go like this, it's coming down. It's going to lose lift. It cannot sustain that, and that's where you've got to sort of take that greedy part of your psyche and shut it off to say, it doesn't matter if it's going higher. This is where, if, let's just say, hypothetically speaking, you sell, in this case, you sell at 3 to 1, 5 to 1, and 8 to 1, but it's all into strength. And then the stock has a big break. Your equity curve is going to be so much smoother if you avoid the big break. So the minute it starts to go parabolic, that's where I'm either setting some type of an aggressive trail or just leaking out more shares. And that's exactly kind of how I handled this position. It's like, and then, as it gets, normally something that does this, I am gone if it gets this parabolic, which is sort of what happened. I think I made 60 or 70% on this, but I took very little heat, where I don't want to stick around for this, then 3-day, 35% decline. Yeah. If I can avoid it, and if I do, I want it to be on a much smaller portion of the original position. And this is something that I think is really important for newer traders, because they're more concerned with, I just want to, I want to buy the low and sell the high. That's a fool's errand. What you want to do is, make more on average than you do when you lose, and maintain an equity curve that doesn't require high amounts of Pepto-Bismol in order to stay in business or to sleep at night.
Yeah. And I also wanted to ask you about the length of that flag, and the high tide flag, and the power play. How many weeks or days are you looking for, or is it more a function of how it's setting up, how tight it's getting, that would get you interested?
I will never go less than 2 weeks. And this is one thing I've seen a ton of over the last 2 years, or guys, they read books like William O'Neill's or Mark Minervini's, and everybody's got a power play with a 2-day base. You know what? If you want to trade those, God bless you, use a stop. And, I'm not going to tell anybody that it's necessarily wrong, but it's not a base, and this is one thing I've noticed. There's lots of people trying to jump the gun on these patterns, a lot of retail breakouts and fakeouts, which is fine, because it just produces, more shakeouts for guys like me. There's always a price to pay as Mark would say. So if you want to go ahead and get in on stuff after 4 days, you're just going to wind up getting rinsed out, or the chart's going to reset again. So ideally, it's 2 to 6 weeks consolidation. And then the other element of that, like I said before, is you don't want to see it give much back. So the less it gives back, the better. But think of it in terms of, if a stock advances 100% and only gives back a fifth of the move, that's really powerful. Where normally, and this is why the setups are rare. If you're seeing these all over the place, you're not doing the analysis properly, because they're not generally all over the place. It's a rare situation where a stock or a market is telling you that there are institutional big buyers that are getting long and not selling. That's, again, it's the rareness that makes it potentially powerful. So, generally, 2 to 6 weeks, and then the tighter the better.
Makes sense. And pivoting now a little bit to a more kind of general type of setup outside of power plays, given that we are now in a correction, there's not many setups out there. What are you looking for to get aggressive again? What type of setups would you like to see, and overall group moves as well would you like to see to get aggressive and start increasing your exposure in this type of market?
Yeah, this is a really good question. And this is where I would tell guys, it took me a while to really understand this, but I am in some ways as excited as I have been in my career, because I just know if you can survive this period, say even in the last 6 months, let's say the last 9 months you're flat, but you're in a style that's, where you're trying to trade any type of, growth or momentum or higher relative strength type ranking stocks, I think you're doing well. You've got a great setup that's coming. When exactly, I don't know. Yeah. That's why you got to do the work. Right now, though, there is very few names that are holding up. So if you study this, even in 2020, everything got clobbered pretty good, with the exception of a few things. And it took a little bit of time to figure out where the next group of leaders was going to be. You had some of those stay-at-home names that kind of came out early. Zoom was a little sloppy. The Teladoc, the Netflix, Amazon types. But then it was almost, it took, I'm trying to remember, the follow-through day in April, and then you had sort of a little bit of a ramp, but it really took till sort of mid-May to late May, where then there were a lot more stocks that started to set up, and a lot of groups. But, some areas of retail, other areas of biotech, other areas of, the enterprise software and software security and that type of thing really started to set up. Right now, I'm not seeing a whole lot, but that can change quickly. There are a few biotechs that, the Veritexes and the Regenerons, maybe. There is a software data and storage a little bit, a name like a Box is held up, but I mean, there's very, very few. Or even in 2018, I remember enterprise software in that cyclical bear market held up really well. And then they just took off. All those names doubled, in the next 3 months or something like that. I'm not seeing anything right now, and which tells me we may just need more time. But this is why you do the screens, you do the work. So maybe we get another rally attempt. Who knows? Maybe the market goes lower. We put in some type of an accumulation day, and you see what are the first names to either try and break out. It could be areas of retail that are going to potentially come out of the other side of this. One thing I will say, though, is if you look at the devastation we've seen under the surface, you want to not avoid completely, but you want to ignore the old leaders. Mm-hmm. A lot of people are going to be trying to bottom pick, PayPal or Square or Arc or whatever was the darling of the last go round. That's the trap. They might work for a trade or whatever, but the real leaders are going to be the ones, that are potentially making new highs, while those stocks are just trying to find their footing and come off the mat. So that's where you want to be looking.
So just to kind of summarize, it's like it's the stocks that are holding up well that kind of point you to the groups to focus on. And then when those start shaping up together, that's when you really get interested and excited.
Absolutely. And like I said, we may need more time to let the market tell you. Don't tell the market,
Right.
Don't argue with the market on why this group should be leading when it's not. That is not my style. But right now, I'm not seeing a ton. This is where it can also change really quickly. So, oil has been the area, but there's been nothing in sort of those classic biggest winning groups in stock market history that get me more excited, which is why everything's been a little bit more of a short-term trade of late.
Yeah. And in terms of things outside of looking at just the stocks, is there anything you take into account, like what the Fed is doing with monetary policy, overall breadth? Is there anything you look at there, or it's really just your screens, what's showing up, what's setting up, no setups? Okay, still need more time.
Well, they're all related, of course.
Yeah.
I have a pretty good understanding, I think, of the macro drivers, and I have some views, but they're never going to override what I'm seeing in the process.
Right.
So, you asked about the Fed. Well, I think right now one of the reasons the market is under quite a bit of pressure is it realizes, or it's finally waking up to the idea that the Fed is going to raise rates, or they're going to raise rates a lot. It's sort of like heads are going to raise rates, tails they're going to raise rates even more. And that generally is a little bit of a headwind for equities. Would it surprise me if stocks start, discounting this at some point and setting up and moving, even if the Fed is still saying we're going to raise? Yeah, sure, that could happen. I'm going to go with the stocks. It wouldn't surprise me either if nothing sets, we continue to see things grind lower until the Fed goes, okay, we're gonna cool off on the hiking, and then the market comes off and we see a bunch of stocks set up. However it works, I'm going to default to what the equities are telling me, not again to what I think the Fed should or shouldn't be doing. But there's no question, the rates market and what the Fed is doing is definitely having an effect. But again, I was getting cautious last summer, last fall, long before, we started to see some of these hiccups and other things. And I'm amazed where if you just get good, again, to our discussion earlier about sticking to your process and playing your game, keep your head and your eyes focused on that, things have a way of sort of taking care of themselves, especially when things get really dicey. I know for people that are new, they're going to be very skeptical of that. I was as well when I started. You mean I don't even have to look at some of this other stuff? And I'm saying, no, you don't. If you get good at running through your own process, that has a way of keeping you out of trouble.
Absolutely. And Mark, the last topic I kind of wanted to touch on with you, touch in with you on is kind of post analysis. And I wanted to ask you kind of what general advice about post analysis you have for new traders who maybe haven't done it ever before, or just want to kind of develop a process that develops that feedback loop where they can analyze their weaknesses and try to address them, make some new rules. So I know you're a big proponent of post-analysis, of course. So what kind of metrics should people look at? How should they go about it? Should they print out their chart? Should they just mark things up in TradingView, whatever charting software they're using? What would you kind of recommend?
Really great question. Yeah, I would say two things for starters. One is you have to do it. So make it a commandment, or a staple in your process that you're going to track everything. And then I would say just to keep it simple. Mm-hmm. Don't get overly complex. I use Excel. I've been doing this since pretty much day one, tracking buys, sells, and then I'll take, if it's a stock, the ticker, the date I bought it, where I bought it, how many shares, that kind of thing, the percent gain or loss, and then I'll make a few notes, but nothing more than that. And then I would, after doing that, I would just go back and study it. Mm-hmm. As far as the post analysis itself, I know some guys like to grade the trades. That's fine, but it's more of just looking for tendencies. And because you want to work on your weaknesses, obviously. You're going to find that, well, I have a tendency to do, maybe it's to hold on to my losses too long. Maybe it's to hold on to my winners too long. Maybe it's to, cut my gains short. And usually guys tend to be, in one or, the other camp. meaning they give stocks too much of the benefit of a doubt, when they're winning and when they're losing, and vice versa. They cut everything too short. And then you can study, like, well, what were the winning setups? What were, why did I buy this name at that period of time? Why did I sell this? All that kind of thing. So I would keep it simple and then look for patterns. So this is really powerful, because if you really study this, you may realize, wow, it was only when I bought properly that I was really, finding some success. That is invaluable, because that's a breakthrough that only you can make in your own trading with time and experience, because it's based on real trades that you made in real time. And if that starts to work its way into your actual process and trading and refine your eye and your tactics, that's when you can have big breakthrough.
Absolutely. And also, during a particular period, do you kind of keep track of stocks that maybe you didn't trade that you should have, like a kind of model book of a certain period, to kind of keep an eye on those ones, analyze those ones as well, so you can kind of analyze why you missed it and do anything. Do you do anything like that?
I don't keep a spreadsheet, say, of trades that I didn't take, but I'll definitely. I will always be watching other. So let's say, like I said, on a watch list, I'm watching things that I had alarms on, right. And I use that as a secondary, as an indicator. Names that I had alarms on. If let's say I didn't buy anything, but 3 names broke out and they all really held well, that's bullish. Yeah. That's feedback, right? That's exactly right. And it's sort of like it's like taking pitches. If you take 3 pitches and they all went in the dirt, you're glad you took them. Where in baseball, if you took 3 called strikes and you never swung the bat, your coach is going to say, "Why don't you take a swing?" Next time you go up to bat, you take the first one, it's in the zone. Then you're not going to take the second one. So it's exactly, it's that feedback.
Perfect. And how often do you kind of do post analysis and look at how your statistics are kind of changing, and do you incorporate that into kind of your sell rules and how aggressive you'll be cutting losses and also taking profits?
Normally I'll tend to do a little more in a lull, but I'll go, after, like, if it's been a busy month or a busy quarter, I'll make sure we've got everything. Right. And this is something I do with my co-portfolio manager. We sort of do it together. But yeah, it's semi-regularly. If we're buying something, we're putting it on the sheet when we buy it. Right. And then we'll go through and put in all the sells, say after we've done a chunk of trades or that type of thing.
Perfect. And Mark, to kind of wrap things up, what kind of general advice do you have for traders who maybe this is their first extensive, correction, bear market, whatever you want to call it? What advice do you have them about, staying optimistic and being ready for that next batch of leaders?
Well, yeah, I mean, you have to understand, where we are in the cycle, and that this is part of the game. Most people struggle with it, I think, because either they lack the experience and the confidence that when things are good, they're going to be able to make enough, or they think of trading a little more, like an annuity. I just want it to pay me the same amount every day. And that's just not how trading works. So yeah, I would say stick with it, continue, to work on your process and hone your skills. If you think of yourself like a high performance athlete or something like that, you always want to be, staying in shape. So even if you're not trading, you can stay in shape by doing your work, keeping a finger on the pulse, and staying engaged. It's worth the wait, is all I could tell you. But you're only going to really learn and see that through experience. There really is no replacing it, but it's also worth putting in some of the hard knocks and learning those lessons, because they can be invaluable.
Fantastic. Mark, thank you so much for coming on and kind of giving us that overview of your system, especially the power plays. I think people are really going to enjoy that. Is there any place outside of your Twitter, which I'll have linked below, that people should reach out to you? Is there a better place to send them?
Well, I mean, you can. I'm on the coaching call at Minervini Private Access every Monday with Mark. I mean, look, I was a subscriber there for more than a decade. So obviously I believe in that product. You can check that out at minervini.com.
Perfect. Yeah, I'll have that link down below as well. To everybody watching, I hope you enjoyed it. If you did, please go ahead and leave a like down below and subscribe if you're new to the channel. And we'll see you guys in future videos. Bye.
Thanks, Richard.